Today we are talking liquidity.
You aren't going to have a meltdown, are you, Jen?
Do you want to test me? When I say liquidity, what do you think of?
The drinks we shared during our last episode of Pub Economics?
Funny, that's not the liquidity to which I refer.
Oh, you mean liquidity as in how much cash a company has and its ability to pay its obligations as they come due.
Yes, Blair, that's exactly the liquidity I'm talking about.
Earnings are interesting, but they're not the same thing as cash flow.
That is a common misconception many business people make.
Earnings include both cash and non-cash items.
Non-cash items include depreciation and various accruals that are required to match the activities of the business to the period in which they occur.
So, understanding liquidity means understanding the ability of the business to generate internal sources of cash from operations.
Sometimes having assets that can be easily liquidated can help as well. Can you identify a few of these assets?
Are you testing me? Well, marketable securities and other types of investments come to mind. Typically, capital assets can take a while to liquidate, so they are less often factored into an assessment of short-term liquidity.
So liquidity is tied to an ability to access cash as required.
Where else can we look, Jen?
Well, I hate to admit it, but let's go back to your beloved balance sheet. Cash on the balance sheet is an easy place to start.
Obviously, the best indication of an ability to pay bills is the cash that resides in the bank.
The cash itself is typically not a return-generating asset class.
No, it's not. So having a bunch of cash on the balance sheet is not always the best use of that asset. So many companies will look to deploy cash or return it to their shareholders. And this obscures the assessment of short-term liquidity.
In fact, many companies have no cash at all on the balance sheet. Explain how that is possible, Blair.
Well, it's only possible when a company has established a credit facility with a bank.
Like a line of credit?
Exactly.
But the bank will limit how much cash they will lend to a company, won't they?
Of course. So knowing how much credit is available and the status of any associated covenants is important to a liquidity assessment.
What do you mean by a covenant?
The banks will typically specify metrics that the borrower must maintain to continue the lending arrangement. For example, a minimum current ratio or a maximum debt-to-equity ratio.
And if a covenant is violated?
Well, then the bank has the right to call the loan.
How else can we assess the liquidity position of a company?
Well, we can also look at the other current assets and liabilities of the company.
Current assets like inventory and receivables are those assets that are likely to be converted to cash in the next 12 months.
And current liabilities represent the obligations that are coming due in the next 12 months.
The current ratio is a common metric that takes the balance of current assets and divides by the balance of current liabilities.
A result of less than 1 is indicative of a possible looming liquidity crisis.
Most times we want to see a ratio of 2 to 1 or more to maintain a healthy margin of safety.
Now, the quick ratio is another ratio that gives the same sort of story, only it ignores the value of inventory.
Why would we ignore inventory? Is this not a current asset?
The quick ratio is more relevant when we want to evaluate liquidity over an even shorter period of time than a year, say a few months. Inventory gets ignored because it can take several months to sell inventory to generate a receivable and then collect the receivable to get the cash.
We can also look at interest coverage and debt service coverage ratios to evaluate whether the company is generating sufficient cash to sustain its lending arrangement with the bank.
Now, these ratios take earnings before interest and divide them by the interest expense plus any scheduled principal repayments.
Obviously, we want this ratio to be more than 1 as well, right?
Exactly. The higher the coverage, the better.
That makes sense to me. You know what else I worry about?
Whether your outfit matches mine?
No, I worry about other less evident obligations that could come due in the near term.
Such as?
Like looming debt maturities, large unfunded capital commitments, or contingent liabilities.
Like lawsuits or a warranty cost.
Exactly.
These sorts of obligations can be large and drain a company of its cash in a hurry.
Speaking of drained,
Enough said on the matter?
I think so.
So until next time.